Have you ever wondered what triggers a market crash and what lessons we can learn from it? In today's video, we are diving into the untold story of market crashes. We will explore 4 major crashes, understand their causes, and uncover the valuable lessons they offer. Make sure to watch till the end to get the full picture. Let's dive in. First up, we have the Great Depression of 1929. This crash is perhaps the most infamous in history, marking the beginning of a decade-long economic downturn. Known as Black Tuesday, the stock market plummeted. Within days, billions of dollars were wiped out and countless investors were left penniless. The primary cause? Poor speculation. In the 1920s, the stock market experienced an enormous boom fueled by easy credit and high investor confidence. Many people borrowed money to invest in stocks, expecting prices to keep rising. However, when the market began to slow down, panic started to increase, leading into a massive sell-off. The aftermath was devastating. Banks failed, businesses closed, and unemployment soared. The global economy was deeply affected, leading to widespread poverty and hardship. The lack of regulatory frameworks led to this situation, as there was nothing in place to stabilize the financial system or provide relief to those affected. So the key takeaway here is the danger of poor speculation. The market boom was not driven by strong economic fundamentals, but by an insane belief that the market would go up forever. Always invest within your means and be aware of speculative bubbles. Additionally, don't invest borrowed money into the stocks or indexes. Real estate can be slightly different due to its underlying value and consistent demand for shelter, but borrowing money poorly for speculative investments is a very, very bad idea. Next, we have the Black Monday of 1987. On the 19th of October 1987, the stock market experienced its largest single percentage drop in history, with the Dow Jones plummeting by 22.6%. This speed and severity of the crash shocked investors and analysts. So, what caused this sudden and dramatic crash? The primary reason was actually algo trading. In the 1980s, algo trading was a relatively new phenomenon. At that time, it involved using computer algorithms to execute large stock orders based on predefined market conditions. So it was nothing very sophisticated, but predefined rules and then execute orders. While these algorithms were designed to maximize efficiency and profits, they also had devastating consequences. They could trigger massive sell-offs. On Black Monday, a combination of factors set off these automated trading systems. Rising interest rates, geopolitical tensions, and overvaluations of stocks created a very weak market environment. When the market started to decline, the computer algorithms kicked in, selling off large volumes of stocks to minimize losses. But this created a feedback loop, where the selling triggered more selling, leading to a market freefall. The aftermath was chaotic. Investors were left reeling and confidence in the market was severely shaken. However, unlike previous crashes, the market rebounded relatively quickly, thanks to interventions by the Federal Reserve, which provided liquidity to stabilize the financial system. So what can we actually learn from this? The importance of understanding the risks of automated trading and the potential for technology to amplify market movements. It's also a reminder that even the most advanced trading systems can have vulnerabilities, and it's essential to have safeguards in place to prevent such cascading effects. Moving on to the dot-com bubble of 2000. During the late 1990s, the rise of the internet and technology companies led to a speculative bubble. Investors poured money into tech stocks, driving their valuations to astronomical levels. By March 2000, the Nasdaq peaked, only to crash shortly after. The bubble burst due to a combination of overvaluation, lack of profitability among those tech companies, and rising interest rates. Many tech companies which had never turned a profit saw their stock prices collapse, wiping out trillions of dollars in market value. The aftermath was harsh. Many tech companies went bankrupt and the market took years to recover. And what can we learn from this? The significance of evaluating companies' fundamentals. Just because a sector is booming, doesn't mean that every company within it is a great investment. Always look at the financial health and profitability of a business before investing. This bubble was triggered purely by speculations. Investors threw money literally into every company related to tech without considering even if the company has potential or is profitable. Let's move on to the latest crash. Lastly, we have the 2008 financial crisis, one of the most severe economic downturns since the Great Depression. This crisis was triggered by the collapse of the housing market and the subsequent failure of financial institutions holding subprime mortgages. So the root cause of it included excessive risk-taking by banks, extremely lax lending standards, and complex financial products like mortgage-backed securities, called MBS. This asset were poorly understood by many and were heavily marketed as low-risk investment. So banks basically issued, as mentioned earlier, mortgages to borrowers with questionable credit histories and just bundled these loans down into the so-called MBS, which were then sold to investors. So banks basically borrowed money to literally everybody who had not even a credit score or a healthy background or something, bundled those loans into this so-called MBS investment products and sold that to investors. And then when homeowners began defaulting their loans, the value of those MBS plummeted. Financial giants like Lehman Brothers, which were heavily invested in these toxic assets, faced catastrophic losses. Lehman Brothers declared bankruptcy in September 28, marking the largest bankruptcy filing in the US history. This event sent shockwaves through the global financial system, leading to a credit crunch and a severe downturn in the economic activity. The immediate impact was catastrophic. Major financial institutions like Lehman Brothers collapsed and others required massive government bailouts to stay afloat. Stock markets around the world crashed and governments had to intervene with multi-trillion-dollar bailout packages to prevent a total economic collapse. The ripple effects were felt globally, with millions losing their jobs and homes. And in this case, so what can we actually learn from this? The critical importance of risk management and transparency in financial institutions. The 2008 crisis highlighted how interconnected and fragile the financial system can be when proper oversight is lacking. It is crucial for both regulators and investors to understand the risks associated with financial products. For individual investors, it's vital to diversify and avoid over-complex investment vehicles like those MBS. This crisis serves as a stark reminder of the potential consequences of unchecked risk-taking in the financial industry. To wrap this up, market crashes, while devastating, offer also valuable lessons for us investors. From the Great Depression to the 2008 financial crisis, we have seen the dangers of speculation, the impact of automated trading, the importance of company fundamentals, and the need for great risk management. The few things I mentioned now are basically the key takeaways from this situation, so keep those in mind. And did you know that there was even one man who didn't even have negative years during those times? His name was Jim Simons. And the crazy thing is, his fund never looked at fundamentals or economics. Instead, it relied solely on mathematics and statistics to code algorithms. Remarkably, he managed to pull in positive returns even during those devastating years of financial crisis. Over the past 30 years, his multi-billion-dollar fund achieved an average annual return of 66%. He was one of the biggest inspirations for me to also start as a quant trader, and since 2021 my algorithm has been consistently earning up to 10% a month, and already close to 10,000 customers are using this AI software to make profits on autopilot. We developed the front end of the software in MQL4 to make it as easy as possible to install it and to give everybody the ability to use it with their broker. With the front end developed in MQL4, you can literally connect it to every broker of your choice. This not only gives our clients the most flexibility, but also the most security over their funds, since they are always on their broker. So if you want to find out more about that, click the link in the description and join the team of winning traders.